Good afternoon and welcome to our webinar today, Affordable Housing Audit and Financial Statement Essentials. My name is Gary Dubas. I'm a partner with McCauley & Asbury, have been for almost 30 years, and looking forward to working on this webinar with Jackie Winchell, who's a director who works in the affordable housing and nonprofit areas in our firm. How you doing, Jackie?
Hi, Gary. Great.
So if you don't know McCauley & Asbury, we are a accounting firm. We're a advisory firm. We provide wealth of services to many clients in many industries. We also do employee benefit plan audits, back office accounting, you name it when it comes to accounting and advisory services, we probably do it. We have offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia here in the great state of Pennsylvania. And so if you ever have any needs, please let us know. We will be glad to help you. I will turn over to Jackie.
Great. And as part of this webinar, we are offering CPE. So we have our first polling question of 5 up on the screen. So answer if you would like to receive CPE for today's webinar. And you will need to answer all 5 of the CPE questions to be eligible for CPE. Great, so it looks like we have a decent amount that's here for CPE and some others that are looking to expand their knowledge here on affordable housing financial statements. Great.
Sounds good.
All right, so we're going to start with our roadmap for our webinar today. So we're going to provide a better understanding of financial statements for affordable housing entities. Gary's going to review the audit process for affordable housing entities and how to prepare for an audit. And then Gary and I are both going to share some best practices that we've seen over the years with various requirements that impact the industry. So we have our next polling question here, and we always like to get an understanding of who is in our audience today. So select what fits your role best. Are you an affordable housing developer, a management agent, or other?
I bet a few people probably could have at least 2 answers, if not even 3.
Yes.
So only one answer is needed.
Yeah, we often see definitely people in this space wearing different hats when it comes to what role they serve. All right, so it looks like actually, I'm kind of surprised, and maybe it's because they fit in multiple buckets, but it looks like a majority of our audience went with other. All right, so first up, we think it's important to kind of understand what are the financial statement elements of affordable housing entities before we start talking about what the audit process is and some best practices. And in order to understand what could be required for your financial statements, you first need to know what are the funding sources. So depending on what funding sources you have, that's going to change what your requirements are for your financial statements. One of the most common sources we see is funding from the Pennsylvania Housing Finance Agency, or PHFA. They have several programs like Fair Funding, Penn Homes. And for purposes of today's webinar, since I believe a majority of our audience is probably also in Pennsylvania, like Gary and I, we're going to focus on PHFA programs, but other state housing finance agencies certainly offer different funding programs. Just know that their requirements may be different than PHFA. We certainly see that with some of our neighboring states like New Jersey, Maryland, Delaware, that they all have some different requirements. You can also get other governmental funds from sources like city, counties, or states through things like the HOME program or CDBG program. HUD also offers a variety of programs, both through project-based vouchers and then also other loan programs like Section 811 for persons with disabilities and Section 223F, which is for refinancing of or acquiring multifamily housing projects. And finally, RD, which is rural development. They offer different loans and subsidy programs to assist rural property owners. And for the bulk of our presentation, we're going to focus on issues with PHFA financing, or if you just have low-income housing tax credits. Both HUD and RD requirements could certainly be their own webinar topics, as Gary and I have seen with working with those variety of programs. So when we always start our audit process, we want to understand, is it a tax credit or a PHFA audit? So typically with these deals, whether it's a tax credit or PHFA, you're always going to have an allocation of low-income housing tax credits. And with that, you have to maintain compliance with Internal Revenue Code Section 42. But what differs then is the scope of the audit and additional compliance requirements if you have that additional layer of PHFA financing. So if you only have the low-income housing tax credit, or LIHTC, those are a tax credit only set of financial statements, or we call them TC only. And that's going to include a balance sheet, which is going to include your assets, liabilities, equity, your profit and loss statement, a statement of equity, and then your cash flow statement under the indirect method. You'll also have notes to the financial statements, and certain investors may require some additional supplementary information on various things that they want to see related to the development. If you have PHFA financing in addition to those low-income housing tax credits, you provide all of the information that I mentioned on the previous slide, plus additional items that PHFA requires. So there's additional supplemental schedules PHFA wants to see. Those include a detailed analysis of any accounts or notes receivable other than from tenants, a delinquent tenant accounts receivable schedule, and that's broken out by both the number of residents and then into aging buckets under 30 days, 31 to 60 days, 61 to 90 days, and over 90 days. An analysis of required reserve funds and escrows. So that's rolling forward your escrow account, where we start with the beginning balance at the beginning of the year, plus any deposits and interest, less withdrawals to equal the ending balance. A schedule showing your full details and explanations of your change in fixed asset accounts for the year. So if you purchase property and equipment, we're going to need to break that out by what type of property and equipment you purchased, or if anything was disposed of during the year. An itemization of operating payables, including the name of who the payable is owed to, the purpose of the payable, as well as the amount of the payable. There will be a computation for surplus cash and return on equity. And then it also requires the name of the lead auditor, as well as an owner signed representation letter and management agent signed representation letter. So quite a bit more is added to the financial statements with this PHFA funding for things that are of interest, particularly to the agency that they want to see. PHFA also requires the direct method of cash flow to be prepared, which this is a different requirement for the tax credit onlys. They have an option of what method of cash flow they want to prepare, and most go with the indirect method because it's the easiest, but PHFA requires the direct method cash flow because it gives more insight into what cash is actually being used for at the property. So it's looking at the actual cash and inflows of operating activities. So cash that you received from your rental revenue, and then cash paid for things like administrative expenses, payroll, and so on and so forth. Where the indirect method is looking at your net income on the accrual basis and essentially converts it to cash basis. So you start with your net income number, add back or subtract any non-cash items and changes in your balance sheet to get to what is your cash net operating income number. And then the final thing that is also in the report is a report on internal controls over financial reporting, or a yellow book report. So because this is government funding, that is what is triggering this additional report. And we, as an additional report, that means we have to perform additional procedures over compliance and getting an understanding of internal controls over financial reporting. And if we have any findings that are a material weakness or significant deficiency, those will be reported in the financial statements, as well as an opportunity for management to respond to the finding of how they're going to correct it. So Gary, we do a lot of affordable housing audits during the year. Do you have an estimate of how many sets of financial statements you've reviewed here during your years at McConley Nasberry?
Oh my God.
Put you on the spot with that one.
So, during our first 3.5 months of the year, I'm looking at probably 50 to 60 financial statements every year. And I think that goes across with our partners and directors that, in our affordable housing area. We're real busy at that time of year. And it's really condensed when it comes to independent audits, because more and more of the investors of the limited partnerships want their draft financial statements and tax returns by like February 15th,
Mm-hmm.
So we really get cranking January 2nd, and it goes by quickly. And some of the things we're going to talk about today regarding the audit process and being prepared, it's essential that we work closely with our clients to get through the audits. One other thing I want to just say regarding affordable housing, most of them are limited partnerships or general partnerships, but there are some nonprofits, especially when it comes to HUD financing. Those may be in the properties, the developments, maybe in a nonprofit organization. So we do audit both of those types of entities. Partnerships again are most of the time, but also nonprofit organizations.
Great, thanks, Gary. All right, and then finally, the last item here that we want to talk about as just kind of the understanding of financial statements is the PHFA Financial Reporting Manual. This is an excellent resource to consult throughout the year for a variety of financial issues for your affordable housing development. As auditors, we often review this in preparing financial statements, particularly during early January when we're getting those first set of financial statements in, looking for any changes. But it includes a lot of requirements for various reports that you're required to submit throughout the year, like annual operating budgets, quarterly operating reports, and the annual audited financial statements. So a lot of those schedules that I mentioned that PHFA requires, there's examples of those in the reporting manual. And one of the most helpful sections, at least for us as auditors, that I think is in there is the PHFA chart of accounts. So if you're familiar with PHFA financial statements, you probably have seen that there is a very specific format that the profit and loss statement is, and a specific chart of accounts that PHFA uses that we need to categorize particularly your expenses into. And so it's really helpful, particularly if you're a newer, if you have a newer affordable housing entity, is to set up your chart of accounts to mirror PHFA's chart of accounts. That makes it really easy to map it to the profit and loss statement that PHFA requires, but it also gives guidance on what PHFA expects to see in each expense category, which can sometimes be a little tricky, particularly if you're looking at those operating and maintenance expenses, like what's an operating and maintenance contract versus what is janitor and maintenance, supplies, things like that. There's great examples in there that can help guide you into how to record expenditures for your property. And Gary is also going to discuss a little bit later today about surplus cash, but there's good information about how to complete the annual submission that PHFA requires of your annual audited financial statements and their newer process now for requesting surplus cash from your agency finance properties. So we're going to head into our next polling question. Do you regularly review the PHFA financial reporting manual? Hopefully we see a lot of yeses in this answer. Okay, we'll just give it a few more seconds. Give everybody a chance to answer. Okay, so we have about 15% that review, 53% with no. So certainly if you have any financial statements that you're either responsible for the accounting for or reviewing, certainly recommend looking at that resource on PHFA's website.
Yeah, the chart of accounts, like Jackie had mentioned, is really important when you're setting up a new affordable housing property accounting system. And to the point of even if you pull out a typical financial statement, audit financial statement, and you look at the profit and loss statement, it is literally in a template. And most of the financial statements that you'll see out there, especially for PHFA financed, are in the chart of accounts format. That is a template that's provided by PHFA. And so that just really reiterates how important it is to report on that fashion. And then you also have to have annual budgets provided to PHFA in that format, et cetera. So it's very standard across the board.
All right, and we are going to, Gary, turn it over to you next to review the audit process.
All right, so now most of the affordable housing properties are on a calendar year, so this may not be audit season. I'm kind of hoping that maybe you have all your audits done for the calendar year 2023, and but it's a good time to kind of step back and think about the audit process. When it comes to audit focus, on this slide, we see three areas that come to mind when it comes to the affordable housing audits that we do. Management override of controls, improper revenue recognition, and then also related party transactions. So when it comes to management override of controls and improper revenue recognition, both of those are essentially higher risk on all audits. What does management override of controls mean? That means that we'll go in and in our audit process, we're going to get documentation. We're going to regarding the main transaction cycles, cash receipts, disbursements, purchasing, payroll, financial reporting. We're going to get the documentation of what your standard procedures are, policies and procedures are for those areas. But the reality is that management can override those, can essentially circumvent those and do things that are not in accordance with those internal controls that have been established. So we have to look at that in our audit planning process to see and think about how how management might override the established controls. And we'll plan a test accordingly to look for unauthorized transactions, essentially looking for things that are obviously material, but our audit process is required to look for material fraud, material misstatements, and so that's one area that we have to look at closely. Improper revenue recognition. There's a lot of revenue recognition was a big standard that we wrestled with in the accounting industry just a couple of years ago, and it didn't impact the affordable housing area all that much. Rental revenue, pretty straightforward. You recognize rent at the beginning of the month that it's due. So it's not a real difficult area when it comes to affordable housing audits, but we still have to look at it. We want to make sure, obviously, revenue is in the correct reporting period. That it, and especially today, where we're starting to see more vacancies, a little more challenges when it comes to collectability that some of our clients are facing at this point in time. Then you have to take a look and see if your reserve for uncollectible rents is appropriate and materially correct. So those are kind of things that we look at when it comes to revenue recognition. And then final on this slide is related party transactions. Typical affordable housing property will have a management agent, management company that is separate from the entity. There are the management company staff, employees, do the maintenance, keep the records, do financial reporting, etc. And there are transactions between the management agent and the affordable housing partnership, for example. And so we have to look at, in fact, to see that those are properly valued, that they're that one property is not getting allocated more expenses than are appropriate for the time that's involved. For example, on maintenance, you know, that maintenance personnel that are doing things for the property, that their time is properly allocated and properly reported. So those are the areas that really come to mind when it comes to audits of affordable housing properties. Our top tips for a successful audit. So got 9 different items here that are listed. Let's go through those. First one is adjusting journal entries, looking at those that happened in the prior audit and ensuring that they are recorded in the current year. And that's something that is always a best practice, is that if the auditor identified and provided audit adjustments, you want to be proactive to look at what those were and get those recorded for the next audit, being proactive with that process. Sometimes what will happen is, and as I talked about earlier, how quickly we're doing these audits. We're doing them in late January, early February, not a lot of time to close the books. We may start the audit, and then the accounting personnel that we're working with will say, hey, here's an additional entry that we have identified. Now we've got an additional invoice in that we weren't expecting, and they provide it to us, and then we record that along the way. We try to, as much as possible, to be as efficient, that we'll look to see if it's material or not. I think it's important to work with your auditors with their workload and working to get your audit done. Sometimes, you can provide us that invoice that wasn't accrued, but if it's clearly immaterial to the financial statements, we would look to pass on it and have it just recorded in the next year. So that's one of the things that we do try to work with our clients on, is trying to be as efficient as possible, but be proactive in terms of looking at typical audit entries, depreciation, get that ahead of time from your auditors, get that recorded if they keep the depreciation schedules for you. I'm trying to think of other ones, Jackie, that typical that we see.
Yeah, depreciation is definitely, I think, the most common, as at least for a lot of our clients, we do maintain their fixed asset schedules. So you can certainly expedite that process too by getting invoices to the auditors in advance of those fixed asset purchases during the year, so you can report the depreciation expense on new purchases.
Yeah, it's that, that type of thing, payroll accruals, prepaid expenses, those types of things to take a look at. Next thing is pay special attention to updating balance sheet accounts that may not have monthly activity during the year. On occasion, some properties actually have a little bit of an investment portfolio, a little bit of, where they'll just have it marked to market as at the end of quarter, or maybe a couple times a year. just want to adjust that at the end of the year. Again, I talked about prepaid expenses. And by the way, when it comes to auditors, kind of a little inside scoop is that, don't spend a lot of time on prepaid expenses. If you have that recorded and for instance, your insurance went up by 10% or so, which unfortunately is kind of happening across the board when it comes to property insurance, just increase your prepaid expense by about 10% or so, and it'll be materially correct, especially if you're doing the payments consistent from year to year in terms of the timing of the payments that you're making on your property insurance. So make the process easy for yourself, and as auditors, we're not spending a lot of time on prepaid expenses, but get it adjusted if it's materially off. Other assets like tax credit monitoring fees, tax credit fees that are paid up front in the development process, PHFA monitoring fees, and that are amortized over the compliance period of 15 years. Get that annual amortization recorded in advance of the audit process. Next year, reconcile bank accounts, including escrows and reserves. Pretty obvious. Don't wait till the last part of the year to reconcile accounts. Have a monthly closing process that really facilitates the end of the year reporting process. I know a lot of our clients, and we recommend clients have a closing procedures checklist that they use every month to close the books. Because often when it comes to affordable housing partnerships, limited partners may ask for quarterly reports. And so you want to do accurate financial reporting throughout the year. So reconciling all those counts and having a closing procedures checklist is a great tool to have in your finance department to make sure that you're doing interim financial statements that are very materially accurate. Next one, number 4, is review any repairs made during the year to ensure the amount was properly capitalized or expensed. So you should have a capitalization policy. For example, might be is that anything that has useful life of more than 1 year and is greater than 2,500, 5,000, etc. Standard capitalization policies, and you want to follow it, plain and simple. And one thing that you have to kind of be concerned about or keep in the back of your mind is you have investor limited partners and they're looking for certain operating losses. They had a projection that was done before the property was put in place, and tax credits and the return on investment are all based on getting that operating losses passed through to the limited partners. That's one of a number of different factors. If you have accelerated depreciation, that type of thing that you're recording, you want to just follow consistently your capitalization policy, and work with your accountants to take a look at net operating losses, etc., to make sure that they seem to be within the range that the projections were showed for net operating losses, etc. So, but again, capitalization, just follow the established policy. Record any partnership equity transactions. So in the first few years of a development, you're going to get equity that's coming in from limited partners. You will have distributions if cash flow is in a positive fashion. So you want to record those appropriately. Record those in accordance with the partnership agreement. Also, based on PHFA, if you have PHFA financing, accordance to their rules and regarding cash flow distributions, but make sure all partnership equity transactions are recorded. Also, one thing that comes to mind is make sure that the prior year audit entries are in fact made. So we sometimes will get into the audit and numbers are not tying in on the balance sheet, and then we find out is that there was a number of prior year audit entries that were recorded in the prior year, but they were not actually recorded on the books of the entity, and so numbers are not tying in. So, but again, back to equity transactions, make sure that those are in fact recorded appropriately. If you have new agreements, you want to keep those, get those to your auditors. If you've got new financing agreements, if you refinanced some of your long-term debt, you know, again, get those agreements to the auditor sooner than later. And number 8 here is confirm deadlines with investors and all external stakeholders. So this is one point I want to make for sure when it comes to the audit process. We talked about how quickly limited partners want these audits. Be proactive if you have a situation where it's maybe the first or second year of operations. It's a lot of accounting challenges, et cetera. Be proactive to contact and work with your auditor, contact a limited partner and ask for maybe an extension of the first year audit, even the second year of operations. Ask for, it may be in the partnership agreement that you need to provide a draft audit, you know, by February 15th. Ask for additional time, and do it well ahead of time. Do it in October, November, so that the limited partner has time to react to it and also plan accordingly. So that's one thing that we definitely recommend.
And that's also helpful advice, because we have seen sometimes where the deadline that the investor gives you can change very quickly, even into late January. We've seen sometimes investor deadlines change. So making sure that you're aware and confirming that deadline is helpful to make sure that you meet all of your requirements to the limited partner.
Yeah, that's exactly right. You know, sometimes also you have an unfortunate maybe one of your accounting staff is off due to a health concern, or you do have some turnover, and now you are having a little more of a challenge getting the books ready for audit. You know, again, just reach out to the limited partner, let them know what's happening, and they can often give you an extension. But being proactive makes the process a much better opportunity to get that extension when limited partners are in the know sooner than later.
Yeah, and also just one other quick point here. Another external stakeholder is PHFA. So PHFA also has a regulatory deadline of 3 months after year end. So if for some reason you're going to miss that deadline as well, asking for some additional time from PHFA when you know you're going to need it is also recommended.
Yeah, exactly. Absolutely. PHFA really likes that, you know, that again, that proactive communication, asking for an extension, letting them know that you're working on it, that there's some unusual circumstances that is keeping you from meeting that original deadline. So good. And of course, obviously, is that when things happen during the year, we do as auditors, we like to hear the communication. You can ask us questions regarding anything new that's happening that you might be unsure regarding recording. Love to hear from you to get it recorded correctly the first time.
Great. And Gary, before we move into the best practices, we got a question, which certainly if there's other questions, feel free to put them in the chat and we'll do our best to answer them as we can. Does PHFA change their chart of accounts often?
No, they really don't. They will update the reporting manual generally every couple of years, and then that is their opportunity for them to make a change. So it doesn't happen. Sometimes accounting procedure or accounting standards will change, and then they'll change accordingly because of that. When it comes to debt issuance costs or other things that may come down the pike, but they don't generally change them too often. And quite frankly, operations are pretty standard when it comes to affordable housing properties. You're collecting rent, you're making maintenance upgrades, you're providing affordable property, a good property, keeping it up to date. So there's not a whole lot of unusual things that are happening. So the chart of accounts is pretty standard.
Great.
So the best practices, we'll quickly hit a few of these that came to mind with myself and Jackie as we put this together. One of the key concepts of affordable housing properties is surplus cash. And of course, everybody talks about cash is king, and it's certainly the case when it comes to affordable housing properties. They are designed to generate net losses, especially for the first 15 years or so of operations, with the high amount of depreciation. But you want to be able to have cash flow. You want to be able to pay the debt when it comes due, and also be able to distribute some distributions to the partners. So surplus cash is an annual calculation that is done. As Jackie had talked about earlier, when it comes to PHFA financed audit properties that have PHFA financing, you do a surplus cash calculation right in the financial statements in your audit. And there's a very specific process that we go through when it comes to surplus cash. When it comes to PHFA financed entities, we'll talk about that briefly. But surplus cash is something you get to know very well in when it comes to affordable housing. One of the things that when it comes to a surplus cash, are we able to move that forward, Jackie?
Yep.
All right. So PHFA financed, I said they have the surplus cash calculation each year along with the audit. And this particular thing that we're going to talk about now applies to agency finance developments properties. So this process actually has changed a little bit. So I'm just going to kind of talk through it versus walking through the slide. So every year, PHFA finance audits are completed. You have the surplus cash calculation, and then if you have surplus cash, you have to go through a process when it comes to being able to be able to distribute that surplus cash. The audits are filed now online on an online portal with Pennsylvania Health and Finance Agency. And when you do file that online, there are a number of questions that are part of that online portal reporting process. One of those is a question that's basically is saying, do you have surplus cash? And if so, do you want it distributed? The partnership has the ability to say, no, we're just going to hold off on getting any distributions of cash. It generally doesn't happen too often, but so if you mark that and say, yes, we do want to get surplus cash distributed, PHFA then will review the audit, and then they will communicate to the affordable housing property and basically say, hey, we've approved a cash flow distribution for the year. And typically when it's PHFA financed, they're going to ask for about 50% of that surplus cash to go towards financing, to paying off some debt, PHFA finance debt, secondary debt, that is, and that's part of the agreement that you have with PHFA. So they'll take 50% of that cash for a debt payment, and then the remaining 50% will be allowed to be distributed based on your partnership agreement. So typically in your partnership agreement, you'll have what we call a waterfall calculation that says for cash flow, here are the priorities in a chronological order that you'll make payments out when it comes to the cash flow. As auditors, we're going to look to see that you in fact distributed the cash flow, you made the partnership distributions in accordance with the limited partnership agreement. So that's something that you do want to be very, very closely monitoring and doing it correctly. And it says here, if the approval for return on equity is not requested and approved, the partnership cannot pay any distributions. It'll be considered an unauthorized distribution. So talking with PHFA recently, if you don't ask or don't request a distribution when you do the online portal audit report, you will have an opportunity that when they get the financial statements and they look at it, you will get another opportunity to request a distribution when they basically communicate to you that there is excess surplus cash. So kind of two opportunities to request a distribution. Here is just the typical PHFA calculation of surplus cash. It takes lines right off the financial statements when it comes to cash, receivables, payables, etc. And that is in accordance with the financial reporting manual, the PHFA surplus cash calculation. As I mentioned, the partnership agreement is part of the process. The surplus cash calc distribution process is unique to each partnership, and you need to look at that right into the partnership agreement to make sure you are distributing surplus cash in accordance with the partnership agreement. And that's where we utilize the terminology waterfall. Typical calculations will pay deferred developer fees up kind of early on in the distribution priorities. Some other fees, administrative fees to the general partner as well as limited partner. Those types of things are part of the typical waterfall calculation.
All right, so we have our next polling question. Which of the following funding sources have you worked with the most? You can select either PHFA, HUD, or RD. We'll give everybody a minute or so to answer that question. Gary, what are the most common funding source that you see on financial statements that come across your way for review?
Certainly is PHFA. I was just talking to a client the other day regarding RD. There's not a huge amount of those that are in our particular portfolio. rural development finance properties, so, and they do have their own, compliance requirements.
Mhm.
So, as well as HUD, of course, and PHFA. So RD is one that we don't see quite as much.
All
And
right.
that's what the poll says. Yeah.
Yeah, so I think that probably, if I had to like look at our portfolio of different audits that we look at, I think that split is probably pretty accurate to what we currently audit. So
That's right.
sounds like most people are very familiar with the PHFA programs. All right, so next we're going to look at utilizing reserves. This is one area that we've noticed that there's been some increased attention from PHFA in their review of the financial statements, is utilizing your reserve account. So as a best practice, you should be periodically reviewing how your reserves can be utilized and making sure that you review your partnership agreement and talking with your either limited partner and or PHFA, depending on what that reserve is restricted for, to make the appropriate withdrawals as allowed. These deals were forecasted to utilize these reserves, and particularly I know with inflation, things like that, there's some properties struggling with cash flow needs. So certainly if you can make use of those reserves, they can be a big help for your cash flow. Next is developer's fee, and this accounting can be a bit tricky. We often see when the property is in development, recording of the developer fee based on payments, so the actual cash that's being paid out to the developer under the development services agreement for this developer fee. This is a capitalized cost into your basis of the building. So the entire developer fee should be accrued by the time the partnership is placed into service and ready for occupancy. I will note that this is regardless of the payments that you're actually making to the developer fee. That's a separate schedule of how the developer actually gets paid that money. I will note that this differs if we have those nonprofit developers on the call, or any developer really. The way you record the revenue of the developer fee differs from how the property records that into the basis of the building. So certainly if you want to discuss how developer fee revenue is recorded under 606, our contact information will be at the end and we would be happy to discuss that. The other thing is if you're an older property and you have no more development cash to come into your deal, and you have developer fee payable outstanding, you want to be aware of how that developer fee is eventually going to be paid off. Typically, there's a maturity date that at some point in the future, typically at the end of that 15-year compliance period, the developer fee is going to need to be repaid. And what we see most common is if there's no development cash left, you're not cash flowing to pay it with surplus cash, at maturity, the general partner is going to have to make a contribution to be able to then, so the partnership can then turn around and satisfy the developer fee. And this can be tricky since a lot of times the general partner is a disregarded entity. It doesn't have cash flow operations coming in. They don't have cash to actually make that contribution. So they may need to borrow money from an affiliated entity to facilitate that transaction. And particularly as we have, some aging properties here in Pennsylvania, we are starting to see this more and more as those developer fee payables are maturing. I know Gary mentioned earlier when he was talking about the audit process, the significance of related party transactions to our audit. So again, with affordable housing properties, we see oftentimes related party transactions for things like management fees, the developer fee payable that I mentioned earlier, possibly some other financing, payment of operating expenses, and so on. So it's really important to maintain accurate and clean records in recording these transactions and making sure both the partnership and the related party books should tie out and match. I think my recommended best practice is to keep track separately, either via spreadsheet or separate chart of accounts. who that is owed to if there's multiple related parties involved. I think it just makes the process a little bit easier to tie out those books when you are reconciling them. You may remember earlier, I had mentioned that one of the supplemental schedules that PHFA requires is a detailed itemization of operating payables that extends to your related party operating payables as well. So we need to know the name of the related party, the purpose of the transaction. So was it for management fee? Was it for payroll expenses? And the amount. And that, again, gets reported on your financial statements. We also need to know it for your cash flow if you are a PHFA finance property that requires the direct method cash flow. So again, we can sort those expenses into purpose of, is it an administrative expense? Is it for payroll? So really important to keep good records about the nature of your related party transactions. Next, I want to quickly review entity expenses. So as most things with affordable housing, the limited partnership agreement is really your best friend here. This is often where a lot of that information comes from. So there can be multiple fees that are paid to one of the partners depending on the structure of the partnership agreement. Things like a partnership administration fee, an investor service fee, an incentive management fee, things like that. And the fee can either be cumulative or non-cumulative. So if it's a cumulative fee, that means that regardless of how it gets paid, it's going to continue to accrue even if there isn't cash available for it to be paid. A non-cumulative fee is a fee that is only paid if there is cash available for them to be paid, typically out of that surplus cash that Gary was talking about earlier. And the partnership agreement is also helpful to understand when you should be making those accruals and kind of what timing you should be putting in that monthly checklist that Gary talked about of when they should be accrued for. So I've seen that some are based on the placed in service date of the property. That's when they should be accrued. Others are at the end of the year. So making sure you have an understanding of when those fees should be accrued. And finally, it can also be reported differently on the statement of profit and loss. So you can refer to your operating budget that you submit to PHFA to help you with the categorization of this, but essentially if the fee is paid with operating revenue that you generate from your rental operations, it's what we call an above the line, and it's included in your profit and loss before depreciation. If it's paid out of surplus cash and cash flow, it's included as another entity expense and is essentially below that operating profit or loss, since it's not being repaid directly from the regular operations of the partnership. And as I think Gary mentioned during the audit process, this can definitely be one of the adjustments that your auditors may propose and make, and we sometimes see missed because it is just that once a year type of entry that's needed on your books. And finally, we're going to review a little bit about operating cash and development cash. So the names kind of define itself, but it's important to remember that from your operating cash account, you should only be using that account to record cash receipts from operating activities. So primarily those tenant rents collected, right? And paying out your operating expenses. So payment of your management fee, your administrative expenses, repairs and maintenance. Your development cash account should have all cash inflows from development. So those are typically going to be your equity contributions and your loan proceeds. And they should only be, those proceeds should only be used to pay development expenditures during the development phase of the property life cycle. So we always recommend that the easiest way to keep track of this is to separate and have separate cash accounts, for one for operating, one for development. That is the easiest way to track that and to really ensure that you're not commingling the funds. And part of the other reason why this is so important then is when we get to the financial reporting cycle, we have to break out your cash flow statement into operating. So you can see the example here that we start with the net loss. And then the adjustments are things that come from operations, like your accounts receivable from your tenants, accounts payable, trade or operations. And then your non-operating column is your development items or things that you don't are not part of regular operations. So you can see in this case here, because the accrued investor service fee is in the non-operating column, it is paid out of surplus cash and not a part of your regular operations of the day-to-day life of the property. So Gary, as an auditor and reviewer of many financial statements, what is your favorite type of cash flow statement to prepare?
Well, when we can and we're allowed to do the indirect method, that certainly is much easier. You know, one of the, like the school of accounting, you know, when you become an auditor and you do your first direct cash flow statement, it is really a learning experience. It's good in that you learn, and Jackie had mentioned earlier, you know, it really puts into operating cash flows into those buckets, you know, when it comes to receipts and major expenses, cash disbursements. So it's helpful once it's done, but it can be painful to put it together, that's for sure.
For sure, I think there's always a pain point. I know when I was a staff, learning that direct method cash flow was a pain point. All right, so for everybody on the webinar, have you prepared a direct method cash flow before? Either answer yes or no.
Be honest now, come on.
All right, we'll just give it another few seconds here to let everybody answer. All right, so looks like 36% of people have and 64% have not. So I don't know if you're the lucky group, those that answered no, but once you get the hang of it, it certainly does give you some more guidance into the operations of the partnership.
Absolutely.
All right. So thank you for joining us for today's webinar. If you have any other future question or think of anything after the webinar, certainly reach out to Gary or myself. We would be happy to answer your question or discuss our services further, and our contact information is here on the screen. And we have some upcoming webinars here in August. So the first one is going to be on August 1st. It's our final webinar of our affordable housing webinar series on acquisition, rehab, and first year credits. August 15th, we have a webinar on our 2024 state and local tax update. And finally, August 29th is our ethics refresher. Certainly, if you're a CPA, I know getting that ethics CPE can always be a challenge. So here's a good chance to get a 1-hour CPE ethics refresher. So thank you so much for joining us and have a good day, everyone.